How is the price of a commodity determined? I mean, who says the price of Bitcoin is 19,000? Let's find out. Hello, folks. Welcome again to the podcast, The Way I See It, which is my views on money, the economy, and the political economy, and how they all intersect. This week, I want to talk about prices. How are prices determined? I mean, who determines the price of Bitcoin or the price of stock or the price of gold or maize? How is that determined? Even the exchange rate, how is the price of $1 to naira determined? How does that happen? That's a good question for us to ask, because the CBN governor, should we say the Nigerian economic community, have a bit of a spat this week about the exchange rate of the naira to the dollar. The naira, of course, being the Nigerian currency. Who is right? How is this exchange rate determined, and how should it be? Well, some background, first of all. The Central Bank of Nigeria, of course, manages the Naira, the exchange rate policy, and they have an official exchange rate. So for every $1 that you have, the Central Bank of Nigeria will give you $380. That's the exchange rate right now, as at November 2020. Yeah. But Nigeria also has the parallel market, which is otherwise known as the black market. Yeah. And this is the unofficial market. So for every dollar that you have, you can exchange that for Nigerian currency, the naira, for about, say, 480, give or take. Yeah. So as you can clearly see, the black market gives you more naira, or should we say the black market has a weaker, values the naira weaker than the Central Bank of Nigeria values the naira. So the question is, who is correct? Is the central bank, which of course is the official manager of the currency, receive the dollar sales from oil, receive the dollar sales when oil is sold, or is it the black market that basically just does the exchanges, the informal exchange of naira and currency? Who is right? Well, it all came to a head in Lagos when the CBN governor was asked, really, at a conference, why wasn't the naira going to be devalued? Because the naira on the unofficial black market was trading at about 480, while the CBN was holding naira at about 380. So the question was, why are you artificially giving the naira strength? It should be weaker, i.e., it should exchange for 480, not 380. And the CBN governor had a very, very interesting response. You can hear him. I'm going to play his response to you guys. Okay.
Parallel market, as far as we know it, and the data that we have, is a shallow market in Nigeria with no more than 5% of market share. Parallel market, and quote me, is a tainted market in Nigeria, where people who desire to deal in illegal foreign exchange transactions, including sourcing of FX cash for purpose of offering bribes, corruption, that is where they deal. And that is where people who are supposed to understand the implication of this on the economic activity on our country begin to go to television and begin to say that our exchange rate is 480. This is very unfortunate.
So did you guys get that? The CBN governor basically is arguing that because the parallel market is just 5% of the total transactions that occur when naira wants to be converted to dollar or dollar to naira, that 5% cannot then determine the prices for the 95% of the market. On paper, he's correct. I mean, the maths are inescapable. 5% cannot determine that 5%. 5% would be an outlier or just a small market. But this is the problem with the CBN governor's argument. In Nigeria, there is a list of about, I think it's 41 or 44 items that you cannot go to the CBN and exchange your naira for US dollars if you want to import. So basically what happens is if you want to import, you go to your bank and then your bank will take an application from you, and invariably that application gets to the CBN. The CBN will authorize the bank to, yes, allow you to create a Form M and issue a letter of credit to your importer or to your foreign correspondent, who then send you the goods, and then the bank pays all that process. Invariably, the CBN can tell the bank, your local bank, not to issue you that formal documentation, which means you can't import. So in Nigeria, there's a list of 44 so items that the CBN has instructed the banks and the brokers not to process forex for if you are trying to import those products. That includes things like rice, tomatoes, milk, cement, all that kind of stuff. You cannot go to the CBN or go to your bank and try to import using currency or using the reserves or the CBN's funds to do those imports. As a matter of fact, the president of Nigeria, Muhammadu Buhari, did say that the CBN should not give a kobo. A kobo means like a cent of Nigerian currency to any importer of food. Although the CBN is independent, that is also a very powerful statement where you have the president saying that the central bank should not fund any, not even a list, any food imports. So if you put these two together, we have a picture where, yes, you can import with the 380 official rate of the CBN, but you cannot import certain items. And among those items are certain products that we can call staples like rice. And everyone in Nigeria eats rice. So if you can't import rice at 380, where do you then get the funds to import the rice from? Well, you have to go to the black market. And the CBN is then saying, if you listen to that clip, he's saying that market is shallow, not just shallow, but it's a market for illicit transactions. So the CBN on one hand says you can't import rice by going to your bank legally. Go to the parallel market invariably. Then the same CBN then says if you then go to that parallel market, you are in a market that is involved in illicit transactions. So you see the disconnect in this. But the major point is this: because the CBN's market isn't open to everybody, then the price of 380 can then not be a true reflection of the total demand for dollars in Nigeria, which means that the 380 represents the demand for dollars, removing many items among the 44. If you take off all those items, then perhaps the demand is then muted, and of course, it then becomes a lower figure, which is reflected in the 380. But on the black market rate, where there are no limitations on what you can import, basically, it then reflects the total demand, which is higher. And because the demand is higher, then the exchange price for the naira to the dollar would, of course, be higher, which is then going to 480. This takes us back to our initial question: how a price is determined in any economy. Well, in 1691, the famous philosopher John Locke, he wrote a letter to the English Parliament, basically. What was going on was that in England, they had this, you could go borrow money from merchants to buy stuff, to import stuff, and all that. And certain rich people, merchants, had written to the English Parliament to say, hey, put a cap on how much these merchants can lend to us. They're lending us maybe a bit too much. Put a cap. Let the government basically regulate how much banks can lend to the private merchants in England. This was way back in 1691, a long time ago. Yeah. So John Locke basically wrote something called, and he titled it Some Considerations on the Consequences of the Lowering of Interest and the Raising of the Value of Money. This is perhaps the first time we see someone describe demand and supply, more or less. That's why this is a very, very important article. So what John is basically saying is that the price of any commodity will rise or fall by the proportion of the number of buyers and sellers, more or less. So he's saying, essentially, when you see the price of Bitcoin at 18,000 US dollars, it is simply the price that one buyer of Bitcoin wants to pay to one seller of Bitcoin in exchange for that commodity. That's basically what it is. That market has determined that 19,000 or 18,000 is the price that a seller will be willing to sell to transfer his Bitcoin over, and the buyer will be able to transfer his cash over. And that price is reflective of that, or that methodology reflective in all markets. So if you go to the stock markets, for instance, what is the price of, say, Microsoft or Tesla? That price is determined by the exchange having buyers on one side and sellers on one side. And then both of them go in and negotiate by offering bids and offers. And eventually, when the price is struck, it is at the point where the seller is confident or is comfortable with transferring his equity to the buyer for cash. So the market exists to create price discovery, whereby I go to the market and I offer my assets for sale, and the seller is able to then give me a price which I feel comfortable enough to release my assets to him. And John went further. He basically said for money, the demand is exclusively regulated by its quantity. So, like he's saying, money, say bank credit or say dollar exchange trade, that kind of stuff, that it is simply determined, i.e., the price, by the quantity of the money in supply. So if you take it again back to banking, what he's saying is if you want to borrow money in an economy and there's lots of money in that economy, then the price you would pay to borrow money is going to be lower than the price someone else would pay to borrow money in an economy where the cash in the economy is not it's not a lot in circulation. Let me give an example. If you were to borrow money in, say, Nigeria, the interest rate you would pay would be, give or take, say 4, 5, 6. It could be more. You could pay a lot more. But if you were to borrow money, if the US government was to borrow money today, it would pay 0.25% or 0%. That is by issuing her bonds. Why? Because there's a lot of capital that is flowing to the US as opposed to Nigeria. So because the US gets a lot of capital flows or cash flowing to the US, the quantity of money is more than the quantity of money in Nigeria. Thus, the US can then pay a lower interest rate. So the ratings, when you see the US has got a lower rating, all that is because the higher the US has a higher rating, I mean, in terms of the risk. Because the rating for the US is better than the rating for Nigeria, then cash flows. Those are the secondary considerations. The point John is making is that money flow or supply of money or quantity of money, once that increases, then the price would reduce more or less. And it's the same with demand and supply. That's how we would then have Adam Smith writing his famous book, The Wealth of Nations, basically then arguing or espousing that same line of thought that John has started by then saying the price of, say, maize is really the price of demand and supply intersecting. So when the demand for maize goes up, if the supply for maize also goes up, then the price doesn't really move. But when the price or the demand for maize goes up and the supply for maize cannot keep pace, then the price of maize will then start to inch up. Same with the reverse. If the supply of, say, Bitcoin in the market starts to increase and the demand for Bitcoin does not keep pace with the supply, then the price of Bitcoin will start to reduce. The same thing if a whale, like us in the financial markets, a big player, comes to the Bitcoin market and simply sells 100 million units of Bitcoin. What happens? That's a lot of supply in the market. If that supply hits the market and demand cannot immediately scoop it all up, then the price has got to go down. Then what you see that over time, either the demand will then come back to the market and scoop all that demand, or that supply stays in the market and the price then remains depressed. So two very important points here, both by John and by Adam, that have written about economics centuries ago. And those concepts are the same today. Price is a function of demand and supply. Higher demand without supply increasing will make the price go up. Higher supply without demand increasing will make the price go down. Simple. There is no other consideration. Prices are determined by demand and supply. So if we go back, eventually now back to Nigeria, the price or the exchange rates that you pay to exchange your naira to dollars should also be determined by the market. if you have a CBN market where entry is restricted to certain items, so if I want to import rice, I cannot go to that market, then that market does not really enable price discovery because it's not a free market to all participants. But the black market, even though it is smaller, it allows all participants into play by posting their offers, by posting their bids. That small market is now more reflective of the larger market, and thus the small market's exchange price is a more realistic picture than the larger CBN market. So in this debate, I will think that the black market or the parallel market in Nigeria, the exchange rate of 480 to $1 is a more realistic price than the CBN exchange rate of, say, 380, because it simply has a reflection of every buyer and every seller in Nigeria. That's my take. That's the way I see it. I mean, I could be right, I could be wrong. You can send me a note to tell me your own views. Do help us in sharing this. Help us in telling your friends about the podcast. Thank you for the comments you've sent on the Twitter. I do appreciate all of them. We are available basically on all podcast channels. Yeah, and I appreciate you guys listening week by week. Follow us on Twitter, FinPlanCaloAjo1. That's FinPlanCaloAjo1. Thank you guys so much. I'll see you all next time. Bye.